Good morning. Good morning for me and for my cat. You might have just heard her a minute ago. This is Stay Curious with Tess, and I've decided that I will be going live on actually every day, talking about financial terminology or financial strategies, things that I've learned in my 35-year career inside the insurance industry, and many things that I've learned in the years, probably it's been 6+ years, that I've been around the infinite banking concept arena, learning more about what the rich do to keep their money working for them in infinite banking process tools. So today I wanted to talk about this thing called saving versus investing. And just as a recap, for the first 12 sessions of this talk that I've done, I more or less kind of defined terms. And now I'm going to talk about learning how money behaves. And today I'm going to talk about the idea of saving versus investing. And I wanted to say, are saving and investing the same thing? And the answer is no. Both are important, but they kind of solve different financial problems. So what I wanted to talk about this because we often hear invest, save, put your money to work. But we really need to define those words. And today I wanted to do exactly that. So the first thing I want to say out of the gate is saving is setting money aside to preserve it for future use. And this will come up for a few different reasons. And the primary reasons are accessibility. It's money that you're going to need in a shorter term. It's money that you're going to want to have liquid so that you can get your hands on it when you need it. You want it for protection. So some examples of savings or money that you might want to put in savings because you want to have access to it quicker are an emergency fund, upcoming vacation, property taxes, insurance deductibles, planned purchases like maybe a car or a down payment on a home, a schooling, education. And I wanted to kind of talk about this because for those that are familiar, the infinite banking process is more of a guaranteed tool. It's a place where your money can go first so that it has an opportunity to work for you before you actually put it to work on something like maybe a purchase of a new roof or a new car or something like that. So infinite banking is a great place to start your money so that it has some guarantees and a tool to kind of like save, like an emergency fund, before you put it to work. So again, I wanted to kind of mention that because I started my infinite banking journey by putting my emergency fund into a high early cash value life insurance policy. And it was my way to test the process. It was during lockdown. And that made me start thinking about the idea. I have deployed money from that and put it into investing. So I thought it was important to kind of talk about the two. So again, savings is setting money aside to preserve it for future use, but it tends to be in the short term for things like emergency funds, upcoming vacations, stuff like that. Investing now is committing money with the expectation that it may grow over time. And the idea is you want it to grow over time, but accepting that its value can increase or decrease depending upon the investment. So its primary purpose is long-term growth. It's not immediate access. It does not come with guarantees, and the potential growth comes with risk. So we know that, like 401ks are not savings that are easily liquid. They're for long-term use. Most people are looking at 30, 40 years down the line. Immediate access. If you're not 59 and a half, you're not going to be able to touch that without penalties. Long-term growth, there is opportunities there, and they tell you, like, that's why people go into the stock market, because they know that they feel that if it goes down over time, it will come back up. But the problem is most people pull that money out the second it looks like it's in jeopardy. So for my life, I've found other alternatives, and my only problem is that I wish I had known about some of these earlier in my life. That's why I'm sharing these ideas with you now. So again, just to reiterate, today we're talking about savings, which is setting money aside to preserve it for future use, but it's in the short term. Investing tends to be more long term because you don't always have access. There's volatility to it, and there aren't guarantees like you tend to have with savings. But the savings guarantees come with a less reward, so to speak, which is why so many people go into the investing arena and then freak out when things go wrong. The big idea here, and why I wanted to talk about this, is maybe neither is better. They solve different problems, And it connects to the idea of making the right choices. What financial decision are you trying to solve? And is the solution that you're picking going to solve that problem? So I wanted to talk about liquidity. In one of my previous talks, I talked about liquidity, and liquidity is the ability to get money when you need it. If your car breaks down on the side of the road, are you going to be able to have access to what you need to get that car repaired so that you can get home or get to the job or be able to transport your kids to and from school? So liquidity would be where maybe savings would be more important, or in my particular case, emergency fund in a whole life policy, high early cash value, so I can access that fairly quickly and then take care of repairs. Had that money been locked up in a 401k and I was 30 years old, I wouldn't be able to touch it. So understanding, is it a short-term savings type idea, or is it a long-term locked up, you're going to pay penalties and you're going to have to answer to somebody to try to get it? So I think that's really important to know. Money needed next month, it has a different job than money needed 25 years from now. And that's why understanding the purpose comes before choosing the financial tool. So I wanted to kind of give you an example. Imagine, you're going to need $8,000 for a roof in 2 years, or $8,000 for a used car or a down payment on a car. Would you treat that money the same as money that you wanted accessible 30 years from now for retirement? Probably not. And why? Because the purpose is different and the time is different. The timeline is very different, and the amount of risk you are willing to take and accept could be very different. Now, and in talking about that, I want to talk just briefly about the infinite banking process. It is a concept where we could put your money to work with the guarantees, then pull it out for maybe some of those long-term investments where there's a little bit more volatility, but at least you've created an opportunity for your money to work twice for you. I'm going to put a link to book a call with me and my partner, Linda Snolt, and we'd be happy to kind of talk more about that with you if you're not familiar. But in the case of this, I'll continue talking about the saving versus the investing so that you kind of identify both and put that to work for you and your family. I wanted to even mention this, like savings versus investing. Cash flow is important, and remember, cash flow is money coming in and then money going out, and that's the flow of your cash. So you want to know that, is that money, if you're getting a paycheck, that money's coming in and you know what your monthly expenses are. If you run into a hiccup, do you have a savings tool where you can inflow some more money to take care of those unexpected expenses? And where is that money so that you can pull it? Liquidity, that's back to the same thing. If we have money sitting in the cash value of a life insurance policy, we can pull that money and we can take a loan, and we're the ones that makes the rules. We don't have to go through all of the hoops that we would to get a loan from a bank. It's something that we can do. We're the bank, so we get to make the rules. So that liquidity is important, because if it's locked up in a 401k, you may not be able to get to it. Opportunity cost, I kind of mentioned that. If you can put your finances or your cash into a high early cash value whole life policy, if it's written the right way, which is how our team does it, you will have access to a cash value that you can use in funding purchases that are fairly short term. And it also grows long term, so there's a huge amount of benefits to it. Opportunity cost, I've mentioned that. Opportunity cost is, can you make that money work for you a couple of times? Compound growth, the idea that it can continue to work for you even with a whole life policy. The way they're set up, we can actually allow you to take loans against your policy, utilizing the cash value as the collateral, so that money can continue to work for you even while you have it out taking care of maybe some financial issues that your family is facing. So I wanted to kind of talk about this today, and I know I've kind of snuck in some infinite banking here. Infinite banking is my life now. Insurance industry has been my entire career. From the time I was out of high school, probably within 2 years of the time I was out of high school, I got into the insurance industry preparing financial statements. And I prepared the regulatory statements for 35 years. So the insurance industry it's my baby. It's the it's the industry that provided a career for me, and it's the industry that was always standing there for me no matter what was happening in the world. I never really had to look for jobs. Somebody knew who I was, and I went from one job to the next one because I was established in an industry that not many people stuck to long term. And because I know so much about the industry, I know about the stability of the policies, which is why I've started doing these talks, is that I want to share what I've learned in the past 6 years that is a beautiful cherry on top of an industry that has taken care of me my entire life. So if there is something you want to learn more about the infinite banking process, please book a call with the link that I'm going to include with this video or any of the other ones that I've been talking about, because I see opportunities for a different way. And that's what I wanted to share. So I'm sharing finance terms because I think that will at least start to have people question and then get into more of what the infinite banking process is so that we can help others. I really see an opportunity for life to be different for many of us if we're willing to challenge what we've always been taught so that we can learn something new. So in talking about this, I just wanted to reiterate, financial decisions aren't about finding one perfect tool, but they're about matching the right tool to the right purpose. And I really do believe that infinite banking is the right first step for all of us, and then we can use these tools to find the next best step. So I want to say that each day, the better question should be, should I save or should I invest? Most of us will say, should I save or invest? But what do I need this money to do should be something you're thinking about when you make the decisions on how you're going to deploy your money. Money doesn't have just one purposes. Different dollars can have different jobs. And I say, if you learn about the infinite banking process, you can have that money have multiple jobs, the same dollar. And I don't think there's a better avenue than that. So I wanted to kind of give you a thought to ponder today. Money works best when it has a purpose. So before choosing the financial tool, define the job that you need it to do. Because I want you to remember that if you define and you understand, you're going to make better financial decisions. And now I want you to stay curious, keep learning, and take ownership of your financial education. And I look forward to sharing with you guys tomorrow. And if you want to book a call with Linus and I, grab the link in the comments, and we would look forward to meeting with you. Thank you.